We learned earlier this week that General Motors likely won't hit its 1 million electric vehicle goal by the end of 2025. And there was a lot of reaction from the market. I thought it was really interesting because Mary Barra and GM had put out really lofty goals about moving to electric vehicles a few years ago. One of them was being all electric by 2035, but they wanted to make 1 million vehicles by the end of 2025. Doesn't look like they're going to be able to do that. But this is an investment channel. So we're looking at this from an investment perspective. And I have a hard time seeing this as not the absolute correct move for General Motors from an investment perspective. If you look at the company's free cash flow and what the competition looks like, what demand looks like for things like trucks and SUVs, that business is doing extremely well, continues to churn out cash year after year. The electric vehicle business, on the other hand, is not doing well. Tesla's margins are dropping. Rivian and Lucid are losing money quarter after quarter. Competition is getting stronger in China. It's getting stronger in the US, in Europe. The EV market is very, very tough right now. And GM is moving into the market. They're actually growing relatively quickly, but they're maybe not going to move into the market at the rapid rate that a lot of people wanted them to. That may be bad from a headline perspective, but I think it's great from an operational perspective. So I want to go through some of these numbers today and show exactly why I think this is the right move financially. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go to some of the headlines to see what the media is saying about this news. You can see here is CNBC saying the GM's EV production capacity target is in doubt after Barra's comments. They said that they wanted to be capable of producing 1 million all-electric vehicles in North America by the end of 2025, although that is heavily in doubt now. The production capacity goal is one of the latest that the company is backing off on. I mentioned that 2035 goal. It seems like that is out of the question for now. They're obviously going to update investors on what's going on with electric vehicles, but I'll show some of the production numbers that we learned recently from GM in just a second. Reuters had a few quotes that were interesting. A GM spokesperson said, "We're being flexible. We haven't announced new capacity targets, and we will build to demand." That is actually what you want companies to do, is build to what there's actually demand for. Mary Barra said at an event on Monday, just because the market is not developing, but it will get there, and we're going to be guided by the customer. So again, they wanted to build 1 million vehicles per year, but there's just not enough demand for that. If you go to GM's second quarter numbers, you see some of these trends here. And I've highlighted this on previous videos, but the company grew sales 1%, and that was on the back of growth at areas like Buick. Cadillac was down just a little bit. We actually did see some weakness in Suburban, Tahoe, Trailblazer, Traverse, but you have a huge increase in Lyriq deliveries. This is their electric vehicle from Cadillac. The Blazer EV, 6,600 units. Bolt EV was down 90%. They're de-emphasizing that vehicle. Equinox EV just starting to come off the line, so about 1,000 units sold. And Silverado EV, 2,200 units. So there is a fair number of electric vehicles that General Motors is selling, but clearly not taking over traditional ICE vehicles quite yet. While the media and a lot of investors in companies like Tesla and Rivian may want to see more electric vehicles sold, may kind of dunk on GM at a time like this. I have seen plenty of that all over the internet. But let's look at the cash flow. I mean, the cash flow, I think, really tells the picture about what's going on in the industry. You can see the column in blue is General Motors. General Motors is generating almost $10 billion on an annualized basis in free cash flow. You can see the next closest is Tesla. Tesla generated $7.6 billion in free cash flow at its peak in 2022. Remember, this is when the industry was undersupplied from vehicles. They were charging a little bit higher prices. Since then, they've had to lower prices, and their sales are now dropping, down 5% in the second quarter. So Tesla may actually go to free cash flow negative in 2024. Rivian in purple and Lucid in green are obviously both negative free cash flow because they have not reached scale yet. They haven't gotten to the point where they can sell a vehicle profitably yet on a gross profit basis. Rivian says that it will get to a gross profit, not an operating profit, but just a gross profit by the end of 2024. So they're way behind Tesla. And if you're General Motors and you're looking at the landscape in the market, you're saying there's a lot of pricing pressure. It's not clear how much demand there's going to be. There's a ton of supply coming into the market. Why in the world would you add to that supply problem and just add to the losses that are being generated in electric vehicles? I think it is the right thing for them to do, to focus on the profitable part of their business. At the same time, they're building out some of their EV capacity. They're lowering the cost of those EVs. That's something they've talked about quite a bit, is some of the changes that they've made as they've delayed some of the production is actually taking cost out of the vehicles. So hopefully they will be more competitive in the future. But the goal of a business is to make money selling products that people want to buy, not just to make great headlines or do what pundits want you to do. And so as a shareholder in General Motors and as someone who wants them to make money selling vehicles, I think it's absolutely the right move to stay with their bread and butter ICE vehicles and not go all in on electric vehicles and that money losing business right now. The money to be made right now is in selling trucks and SUVs and even smaller vehicles to a large extent over the last year or two. That is where GM is going to be able to make money as all of its competitors are floundering, burning through cash, trying to build out their electric vehicle capacity. Now, the company is likely going to be able to make adjustments in the future. Maybe they'll be able to acquire another manufacturer. But I think from a strategic standpoint, this is absolutely the right thing to do, despite the fact that a lot of people in the EV space are kind of laughing at GM right now. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The final thing I want to go through is the valuation for General Motors, because I think this is what really hammers home how much investors are underestimating this company and how much growth they're really expecting from these EV companies that I don't think fundamentally are going to have different economics from automakers over the past few decades or even the last century. So GM right now, as I'm recording, according to FinChat, has a price to earnings multiple on a trailing basis of 6 and on a forward basis of 5.2. That is a very low price to earnings multiple for any company, especially a company that is just generating consistent cash flow year after year. Let's look at how this compares to some of the competitors I've talked about earlier. This is the price to sales multiple. You can't really look at the price to earnings multiple because Rivian and Lucid are not making earnings, and Tesla is not making much as far as earnings go. I believe their price to earnings multiple is like 60 or 70 right now. But price to sales is a little bit more apples to apples. And you can see that General Motors price to sales multiple is about 0.3. Next closest is Rivian, which is 10 times higher than that. Tesla's is at almost 8. Lucid is at 10.7. So there is a ton of growth priced into those stocks already without the ability to show the performance that they're actually worth that valuation multiple. So again, when you look at the finances and you look at the valuation, I think this is just a no-brainer. General Motors is the best automaker out of these 4 companies that I have talked about here. Yes, it is a legacy company. They are making legacy products, but I think those legacy products, ICE vehicles, are going to be around for much, much longer than a lot of people think. We are making a transition to electric vehicles, but it's going to be much slower and it's going to be much more painful for a lot of these manufacturers than I think we really anticipated a few years ago. Fisker saw that recently. They filed for bankruptcy. That's not going to be the last bankruptcy in the electric vehicle space. And so if you're General Motors, happy to sit on the sidelines and just watch how this plays out. This is a stock that I'm going to cover more as they report earnings, but expect free cash flow to be really strong compared to a lot of these other companies. And you never know when the market is going to turn on some of these electric vehicle stocks, because I don't think that there's going to be all that much revenue growth or free cash flow coming to them in the future as this market gets more and more competitive. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.